right, I've been asked to make a video on cash secure puts, so let's go ahead and get started over here. Simply, we're going to pick our favorite ETF, SPY, go into chart, and we're going to pick a good place where we can make some money selling cash secure puts first, right? I think let's focus on that. A lot of you guys are selling the cash secure put, understand that strategy. So let's just, review it in detail, make sure we have our basics in place. Looking at the chart over here on the weekly, we see SPY, the low is 348, but we see a pretty good support here around this area right here where my cursor is, give or take the 375, 380 range. Let's just pick 380 as a round number. And if you were to go ahead and sell a 380 cash secure put right here, we're selling one, the December 19, 2025, 380 put, one contract. We're getting roughly $4.20 credit per contract, which works out to $421 in premium should your SPY stay above the 380 price range. Pretty straightforward. No issues there. I think everybody kind of understands the strategy. Now, what is the put ratio spread, right? So let's understand the key word in there, ratio. What we're doing here, you're just selling one cash secure put, right? With the put ratio spread, you're buying one, selling two. Okay, so we're gonna do one contract. We play very small numbers in contract. We're not professional players here, or working for a big bank or a trading firm, so we're not trading billions of dollars. We've got a very small portfolio, so we like to keep the number of contracts small and the probability on our side, right? So you're looking at doing the ratio either, if you buy two, you're selling four. You buy one, you sell two, right? So let's construct a put ratio spread and what that looks like over here. So we're going to keep our 380 short strike, right? Like we would for our cash secure put. So we're going to go out one over here and we're going to buy the 385 and then we're going to sell the 380 and sell one more 380. So this kind of constructs the put ratio spread over here on SPY. So buying the one at 385, this is your protection, and then you're selling the two at 380. Okay, so let's go look at the math on this, see how this works out over here. Let's go back to our cash secure put single entry, right? We're selling one SPY December 19 for 380 put, collect roughly $4.20 premium. Our break even is 380 minus 420, 370.80 is our break even. Our max profit should SPY stay above 380 is $4.20 credit that you collected, or $420. If SPY were to continue dropping, you don't get anything extra, you just keep losing money. The put ratio spread, like I mentioned, we're buying one SPY at a little higher strike. So in this case, the next available strike was 385. And then we're selling the two. We're selling to open two SPY at 380 put, the same 380 put over here. The mechanics of this works out as what we're getting, as you can see from here, we're getting about $4, right? Give or take. So we're selling the 380 put. We're getting a $5 extra. This is the spread that we make money if SPY were to continue dropping past 385, and I'll show you that in the risk analysis chart over here shortly. And the $4 credit that you're getting with your break even, assuming full assignment at 371, which is a little bit lower than 375, and you're getting a little bit more money over here. You're getting the $5 profit trap plus your $4 in premium that you collected, as you would, selling your cash secure put. So you're getting $9 extra in premium over here due to the profit trap, right? So let's see how this works out. If SPY stays above your 385, you only get the $4. Pretty straightforward, just like here, right? If SPY were to go below 380, you're getting, like I mentioned, your $4 premium that you collected plus the $5 profit trap. And let's see what that looks like here in the risk analysis graph. This is the risk analysis graph of that put ratio that we talked about. Anything over 385, you're collecting your $4 premium, right? So as SPY keeps going lower and lower and lower, you're still making your $4 in premium, and life is good. As soon as it hits below 385, you start making a little bit more money. And this is where your debit spread part of that put ratio comes into play. And you have a little profit gap over here that you can collect if SPY were to continue dropping over here in price up to the 380. Now, if it blows past 380, you start losing the money. You gave up a little bit of that profit. You gave up a little bit of your $4 there, and you lose essentially your $9 premium that yet you would make in total, and then your break even hovers around 371. I hope this makes sense to you. Let me know if you have any other questions. I've been trading cash secure puts for a long time. I ran into this strategy over here. Depending on the strikes and how far you go out in the put ratio spread, you may not end up making that much in initial premium that you collect versus your cash secure put. But if you're like me, when things go bad, the way your luck works, when things go bad, they go to worse. And why not make a little bit more money when things are going from bad to worse? You make that little $5 profit here if things were to go a little bit against you. And if, it's just like anything else, they keep going against you. Well, you're just out of luck and you're going to start losing money. But it kind of feels good to, kind of keep your probability trade and have a little bit of extra in premium if things were to go a little bit against you. Ideally, if this were to close at right at 380, you don't get assigned. You get your initial $4 plus your $5 gap, and life is sweet over there, collecting 900 versus just the 420 that you would have collected if you just done a regular cash secure put. So I hope that helps. Let me know if you have any questions. Thank you. Bye bye.